Hey everyone, Harvey Steele, Head of Intermediary with Westwood. Thanks for joining me today. As you may have seen, we've recently published our top 3 allocation shifts for 2022, and today I'm going to talk to you about our top 1 allocation shift. You know, as we all know, looking forward, there's really no secret that 60-40 from an allocation standpoint is going to be challenged. I think we all know the reasons why, but I'll hit them real quick. We have low rates, we have high equity multiples, we have inflation. I think most people have gotten around to the point that things are going to need to change. You know, unfortunately, though, when we look forward at 2022 and 2023, we see a lot of pain in the fixed income side of the equation, particularly in high yield corporate bonds. And if you look at the allocation shifts that financial advisors, broker dealers, and many asset allocators have made over the last 2 years, they've really started to express themselves in high yield corporate bond in search of yield. And there's really a lot of opportunity to disappoint here. So let's talk about 2021 and what high yield did for you this year. Obviously, we had a very, very bullish equity market, but the high yield corporate bond category in Morningstar is up less than 4%. Spreads are now down around 3% near historic tights. Where do we go from here? So let's talk about it a little bit. Where's your upside? We stay stable, equities continue to grow. We have a low absolute yield. We have interest rates that may rise in 2022 and 2023. We have inflation, and there's not a ton of room for spreads to get tighter. So in a stable to good market, high yield has the opportunity to disappoint you. But what if things go bad? Well, we have a couple charts we're going to show you. First, we're going to show you a chart that talks about when spreads blow out, 2008, 2010, 2020. Leading into those time periods, typically spreads are around where they are now, and they typically blow out to about 1,000 basis points. If you look at average peak to trough returns during those time periods, on average, you're down over 25% in price. So here's our top idea. We are very bearish on standalone high yield corporate bond funds today, and we're bullish on the Morningstar 30 to 50% equity allocation category as a replacement, specifically the Westwood Income Opportunity Fund. And I'll show you why in a couple charts. First, chart number 1, let's assume things stay positive. The equity market keeps chugging along, we have inflation, rates start to tick up. Over the long term, the Westwood Income Opportunity Fund has outperformed the high yield corporate bond category in Morningstar and benchmark over the last 1, 3, 5, 10, and 15 years. Now, I know what you're saying. Probably saying, well, you know, this category probably has more equity correlation, more volatility than the high yield corporate bond benchmark. It doesn't. In fact, they're very similar, and we're going to show you that. What happens if things go off the rails and things get tough? Well, we looked at every time period over the last 15 years where spreads blow out by 200 basis points or more. And over those time periods, on average, the Westwood Income Opportunity Fund gives you less than 2/3 the downside of the high yield corporate bond benchmark. So we're very bullish on their trade. We'd love to chat with you about it. If you're interested, hit us up on social, email, or call us. All the data is on the screen. Talk to you soon.